I'm speaking with Harry Boxer today about risk management. Hi, Harry.
Hi.
A lot of people forgot about risk when the market was going up, and it's come back to sort of square and center. What do you recommend about risk management?
Well, first of all, it's suicidal to trade without stops, and because you just don't know how far something can run once it breaks. So manage your positions with stops and put those stops in a logical place. Usually when a trend line, moving average, or support level is broken, sometimes all three are in the same place, and that makes it easier.
But if everybody's watching it, don't you run the risk of being stopped out and then the market going back where you
Right, but that's why I always tell people, give yourself a little leeway. An extra 10 or 15, 20 cents, whatever, on day trades, or maybe a little bit more on a position play. But when a major, and also watch for the following. If a trend is suddenly reversing its characteristics, where they're going up on good volume and then pulling back on low volume and consolidating bullishly, all of a sudden you're at the market's been up for a while, or a stock's been up for a while, and it breaks hard on heavy volume. Then it starts to rally on lower volume. The characteristics of the whole trend are changing, and probably that thrust to the downside on heavy volume was the thrust that broke the back of the trend and started a new downtrend, initiated a reversal, I should say, and started a new bearish trend. So that's what you need to be careful about and watch for. I think the number one key is, once it breaks, what's to do after that. If it can't rally, or it rallies lightly on low volume, you probably should exit.
How about those that have successfully sold the market and now are looking for an exit? What's the exit strategy?
Well, the other side of the coin is trade with objectives and targets in mind. I tell all my day traders and my position players at all times what the initial and secondary target is. That's all based on projected prices, based on prior resistance, support levels, etc., based on measured moves, based on a lot of different technical factors. I will give them targets. I usually say, if you want to continue to raise your stops as it gets near the target, that's one strategy. If you want to exit half your positions at the initial target and ride the rest to the secondary target, that's the way we trade them. Also, try to keep it as short term as you can. In this market volatility, some of the stuff we hold is intraday. We're not even looking to hold stuff overnight. But for a lot of the people who can't day trade and are looking for more position plays, you have to keep a shorter term time frame in mind and be willing to accept less money. Most of the trades we took last year were between 20 and 40% or more. This year, I've seen a lot of 10 and 15% trades whittle away and go into a loss position because the market is so volatile and it's not allowing stocks to trend. So from that aspect, also the last thing I would suggest is perhaps broaden out your positions from 2 or 3 positions to maybe 6 or 7, so that you spread your risk a little bit.
Okay, diversify.
The smaller positions, more stocks. I don't want you to be a mutual fund either. You don't need 20 or 30 positions, but a maximum of 6 to 8 positions, as opposed to putting all your money in 1 or 2 stocks and watching then one of them gap down big and you have a big percentage loss. So we try to avoid the big losses. Keep stops in, have targets.
Harry, thanks for your time.
You're welcome.
I've been speaking with Harry Boxer. You're watching the MoneyShow.com video network.